Well, hello everyone. In this particular recording, we're going to go through our homework for our colleges and universities chapter. And what we're going to do here, we're going to go through three problems. First, I'm going to take a look at accounting for a private nonprofit college. And then we're going to take a look at journal entries for a public nonprofit college. And then there's one homework problem where we take a look at various transactions and we look at private versus public colleges side by side. So that's a really good one. It really shows you the differences and the similarities between private nonprofit colleges and public nonprofit colleges. There are differences. Now remember, we're going to go through this first one, Steiner College. This is a private nonprofit college, and private nonprofit colleges use FASB standards, the FASB nonprofit standards, to go through their journal entries. I want to point out a few things here. With private nonprofit colleges, equity is called net assets. And if you recall from our prior chapter, net assets are broken down into two subcategories: without donor restrictions and with donor restrictions. Okay, here are some of the journal entries that we are going to go through. So journal entry number 1, we've got during the year, charges for tuition and fees were $244,500. Scholarships were $16,300. Tuition waivers were $5,100. After payment was received, tuition refunds of $11,200 were given. Tuition waivers of $17,300 for students serving as teaching assistants for instruction were also accrued. So the first thing you have to understand is that tuition and fees are going to be recorded at their gross amount, regardless if they're going to be collected or not. So we can see tuition and fees without donor restrictions is a total of $244,500. That is the total amount. That is the gross amount. Now, we have only $223,100 is collectible, right? So we're going to debit the receivable only for the net amount we're going to collect, and the additional amounts are going to be recorded in a contra revenue account, a contra tuition and fees account, and that'll be called tuition and fees discount. Do you see it comes to $21,400? Now, what was that $21,400? It's basically the scholarships of $16,300 and tuition waivers for scholastic achievement. Effectively, they're one and the same. So these are internal scholarships. It's not external, right? These are internal scholarships, which means the university is not going to be receiving this $21,400. All right? So that is what the $21,400 is. Another thing that happened here is after students registered for class, they decided to withdraw from class right away. They're going to get a refund of their monies. Refunds, tuition refunds for withdrawals are going to be debited directly to the tuition and fees account. There's no contra revenue that's used with refunds. It's kind of like it shouldn't have happened to begin with. It's the student registered and they said, "Oh, my bad. I'm gonna withdraw from class. It's too much, or I don't like the teacher," or whatever the excuse is. They're just withdrawing from class. So we're going to debit the revenue account directly, and the credit goes to cash. And last but not least, some students are actually hired as employees of the university, and as part of their pay, you're going to see that the pay is going to be an instruction expense. Okay, debit the instruction expense, credit the accounts payable, okay, for $17,300. That's what's going on here. All right. Number 2, college is receiving cash contributions. So in addition to tuition, the college is receiving cash contributions. All right. Some of it comes without donor restrictions, $2,080, without donor restrictions. Pledges to be collected next year, $550. So that is it's still unconditional. We're going to get the pledge, but it's restricted as to time. And then, of course, we have cash contributions for the endowments. That means a a permanent donor restriction, 335. And it also collected 820 in pledges receivable that were unrestricted. So previous pledges receivable that was recorded is now being collected. So let's see. Let's put this all together. What do we have? Well, we're collecting cash of $3,235. Once again, that is the 2,080 cash that we are receiving, plus the $820 in pledges that were previously recorded as a receivable, plus the $335 permanent endowment. If you add those three numbers up, debit to cash. And you can see the 2,080 is a contribution without donor restriction. The 335 is a contribution with donor restriction for the endowment. And the 820 is a collection of the receivable. The other 550 that was collected is actually, I'm sorry, not collected, but it is a pledge to be collected in the future. It's an unconditional pledge, so I'm going to record it with a debit to pledges receivable, and the credit is going to go to contributions with donor restriction. It's a time restriction. So we've got a couple of things going on here. We've got some collections of contributions without donor restrictions and some with donor restrictions. Okay, the next one, number 3. That was a little challenging, but hopefully you got through that one. Number 3, all we're doing is collecting on our tuition receivable. Very simple. Debit, cash, credit, receivable. Okay, where are we? Debit, cash, credit, the tuition receivable. Pretty simple. Number 4, net deposits returned to students totaled 10. Now you have to keep in mind these numbers are in thousands, so it's actually not $10. It's actually $10,000. If you're thinking, some of these numbers are pretty tiny for a university. Yeah, because the last 3 zeros are dropped off. So remember what we talked about in this chapter. When there is, when the university gives university property for temporary use by the student, whether that's a dorm room or maybe scientific equipment or whatever the case may be, what happens is the university receives a deposit from that student. It's very similar and comparable to if you moved into a new rental apartment and you had to initially pay up front to your landlord a security deposit. That's just in case there's some sort of damage. And that's exactly what the university is doing here. And that deposit is now returned to students. So you're going to see the journal entry is debit this deposit held in custody for others. That was a liability. We're basically giving it back. So we'll decrease or debit the liability and reduce cash with a credit. All right, number 5, we just have various expenses, and we can see the breakup here between instruction, academic support, student services, as well as institutional support. And right underneath it, it says related to the expenses. So we've got those, we'll debit those expense accounts, and it says prepaid assets of 534 were used. All right, so we're going to reduce our prepaid expense with a credit. 4,776 of these expenses were accrued, so we will credit accrued liabilities for that. And the remaining expenses were paid in cash, so we'll credit cash for the remainder. And lastly, it says expenses incurred resulted in the release of 7,320 in net assets with donor restrictions. So we also have to release $7,300 worth out of the restricted and into the unrestricted or without restrictions. A couple of things going on here. So first, if you take a look at the first journal entry, as I said, we're going to debit the various expense accounts, credit cash, the bulk of them were paid. 534, the prepaid expense, which is that the asset, is credited, and the other 4,776 was accrued. In addition to that, we're going to release restrictions. So you can see journal entry 5B, debit net assets released dash with donor restrictions. That means it's going down with a debit. And we will credit net assets released dash without donor restrictions. That means that category is going to increase. All right, number 6, the ending balance in accounts payable was $1,935. So basically, we need to do a little math. The beginning accounts payable and accrued liabilities is right up here. That was their starting point, $21,130. And what did we do? It looks like we increased it here in 1C for $17,300. And we increased it again, $4,776 in 5A, minus what the ending value was. I think the author said $1935. If you do the math, it works out to, that means $41,271 in accounts payable was paid. Debit the payable and credit cash, reduce cash. Number 7, investment earnings received for the period, $3,960, of which $2,070 was restricted. So we're going to debit our investment account, our asset account. We will do so with it. We'll increase it with a debit, and we will credit all of our unrealized gains. Okay, and we said, according to the breakout, 3,960 of it, I'm sorry, 2,070 of it was restricted for donor, donor restricted for scholarships, 2,070. So when we take a look at this, we can see that we're going to break up our investment increase as follows. So I'm sorry, I'm in the wrong one. Where are we? Here we are. 2,070. We're going to debit cash because that's what we're receiving. We're going to credit investment income with donor restrictions, and that means the remainder is without donor restrictions. All right, number 8. Number 8 is really all the adjusting entries at the end of the period. We have multiple journal entries here. Let's go through them one by one. So the first one is increasing the allowance for doubtful accounts by $20. And so the interesting thing is with private nonprofit colleges, instead of recording a debit to a bad debt expense account, as you see here, the debit goes directly debit against the tuition and fees account. So there's no expense. We actually debit the tuition and fees account directly, and we'll credit the allowance for doubtful accounts, the contra receivable. We're also going to record depreciation expense of $26,400. And you can see we're going to break that up between instruction and academic support. I think it's a 70-30 split. Debit the expenses, and we will credit accumulated depreciation. We're going to adjust tuition revenue to increase unearned revenue of $10,000. So basically what's going on here is whenever students pay for tuition in advance of when the semester starts, if it crosses over fiscal years, what we need to do is we need to increase this liability called unearned revenue, all right, for any prepayments, if you will, of students if they're paying their tuition, but for instruction that's going to occur in the next fiscal year. And in this case, we're going to increase our unearned revenue, our liability account, by $10,000 with a credit, and the debit is going to go to tuition revenue. We collected the money. We originally recorded it as tuition revenue, and that needs to be adjusted downward. All right, and last but not least, our investment portfolio balance went up by $4,700, and we can see the breakup. $790 was related to investments restricted for scholarships, $1,610 related to a permanent endowment, so that's a permanent restriction, and the remainder for net assets without donor restrictions. So we can see that here, debit the investments, and we'll credit all of our unrealized gains. Some of them without donor restrictions and some with donor restrictions. Okay, and number 9, we're just going to go through the closing entries. So you're going to see that the closing entries, we've got a number of them. And why do we have a number of them? Because remember, with nonprofits, specifically private nonprofits, we want to go through our closing entries for each category. So we're going to close out first our without donor restrictions. Remember, there's like multiple, it's like two operating statements, 2 income statements in one. We've got a column for without donor restriction, so we'll debit all of our revenue items to close them and credit all of our expenses. And then we'll debit and credit whatever is needed to balance the journal entry to net assets without donor restrictions. Next, journal entry 9B, we're going to close out our revenue with donor restrictions. We'll do so with debits, and the credit is going to go to net assets with donor restrictions. And 9C, you can see we're going to close out our contributions with donor restrictions for the endowment. So this is more of the permanent restrictions. Debit them to close it out, credit net assets with donor restrictions. And last but not least, number 9, if you recall those accounts, net assets released dash without donor restrictions, that had a credit balance, so I will close it with a debit, and the credit is going to close out directly to net assets. Net assets without donor restrictions. Okay, and then of course this should say net assets without donor restrictions. There's a little typo here. It should say without donor restrictions. And then of course our net assets released dash without donor restrictions. We will close that out, and it will get closed out directly to net assets with donor restrictions. We'll close that out with a debit, okay? And so this should say net assets with donor restrictions. So a couple of typos there. But you understand that net assets released accounts get closed out to net assets. That's what's going on there. All right, so after the journal entries, let's take a look at what we're going to do. Oh, I guess that's it. That's what we're having for that particular problem. Private, nonprofit, college. Now the next one, we're going to take a look at a public nonprofit college. This is similar to FAU, Florida Atlantic University. With a public nonprofit university, we are going to use GASB standards. And what I want you to do is I want you to think back to the chapter when we talked about proprietary funds, because a public nonprofit university is accounted for as just like an enterprise fund would. We'd use accrual accounting, all right, but we're going to follow those GASB standards that we learned in that chapter. So very similar to what we just went through. Let's go through the journal entries. I want to point out that the equity, as in the previous example, when it was a private nonprofit college, equity was called net assets, but public nonprofit university, equity, if you recall from that chapter, is called net position. And net position is broken down between unrestricted, restricted, and your net investment in capital assets. That is a lot different than your net assets broken down between with donor restrictions and without donor restrictions. Some of the transactions are similar, some are different between the private and public, and you will see that here. Okay, so first, number 1, South University billed tuition and fees, $1.5 million, and provided $250,000 in scholarship waivers. All right, so we're going to record the revenue for the gross amount. That is the same as a private nonprofit university. But we're only going to record the receivable for the net amount we're going to collect. And the difference between the two, we're going to record a debit to a contra revenue account, tuition and fees discount. Number 2, unearned revenue at the end of last year was earned during the current year. So if I come back up here, I can see I have a line item called unearned revenue, $25,000. Well, that was earned in the new year. So in the new year, I can reduce the liability with a debit, and I'm going to credit revenue. Number 3, notification was received from the federal government that up to $50,000 in funds could be received in the current year for cost incurred in developing student performance measures. Well, if you think back to your chapter when we talked about enterprise funds, whenever we receive a grant that is to be received in the future after we do something first to earn that money, we actually do not record a journal entry at the time of the grant notification. That is a little different than a private nonprofit college, and I'll show you that in a few moments. But for here, a public nonprofit, we didn't earn that money yet, so no journal entry. Number 4, during the year, the university received an unrestricted appropriation of $3 million from the state. Now, one of the beautiful things about public nonprofit universities is they are part of the state government. So they are going to participate in the state government's budget. And that's what's going on here. The budget for the state is allocating $3 million to this particular university. So the journal entry is debit cash, and we're going to credit revenues for that state appropriation of $3 million. Number 5, equipment for the student computer lab was purchased for cash, $525,000. Debit equipment, capital assets, credit cash, very simple. And we will depreciate that over its useful life. Number 6, during the year, $800,000 in cash contributions was received from alumni. So here we have some donations. $800,000. Of the amount, $200,000 is to be used for construction. Now remember, with public universities, we have to break up our equity between unrestricted, restricted, and net investment in capital assets. Well, at the time that we are receiving this donation, the $200,000 is to be set aside. The $200,000 at this moment in time is going to be restricted. We're going to see that later while we're recording the journal entry, debit cash and credit revenue. But remember, later on, that $200,000, we're going to see that we're going to actually record that in a restricted amount, a restricted equity account. I'll show that to you later. Number 7, interest expense on the bonds, $48,000 was paid. Journal entry, debit interest expense, credit cash. Pretty straightforward there. Number 8, student refunds. All right, so number 8, there's actually a lot of journal entries going on. First, some student tuition refunds were given. So this is when students registered for a class. They paid for a class, but they changed their mind about their registration. So they're simply going to get a refund. That refund is going to be recorded as a direct debit to the revenue account. There's no contra revenue account used when it comes to refunds. Debit the revenue and credit cash. That was part 1. Part 2, cash collections of tuition and fees. All right. Totaled $1,458,700. $138,000 of that is applied to the semester beginning in August of 20. This is important because when does the year end? These are the transactions, and I'll highlight it here. For the year ending June 30, 2020. So when the semester begins in August of 20, that is the next year. So that $1,458,700 we can record as a debit to cash. All right, but $138,000 of it is applying to the next year. So we're going to credit a liability account called unearned revenue. The difference is going to be basically a collection of the receivable that we established when the students registered for a class. And then there's a second part to that let's highlight it. Investment income of $13,000 was earned and collected during the year. So that $13,000 we will credit the investment income, and that's part of the cash as well. All right, number 9, general expenses. And we're going to break out the general expenses. $4,684,000 is related to administration and operation of academic programs. $37,000 research related to the development of student performance measures. And at June 30, 2020, the accounts payable balance was $75,000. So basically what we're saying is here we've recorded some expenses, and we would do so by debiting the various expense accounts. All right, and we're going to credit accounts payable. All of it was paid, all right, with some exceptions. It says the balance was $75,000 in accounts payable. So what we need to do is look at the beginning accounts payable of $105, add in the increase to the accounts payable of $4,721,000, subtract out the ending payable of $75,000, and we do some math, and voila, we've paid $4,751,000 of the payable. Debit the payable, credit cash. All right, now do you remember we said earlier, let me refresh your memory. Remember up in 3 when we did not record a journal entry? And why didn't we record a journal entry? Because we haven't done anything yet. Here it says notification was received from the federal government that up to $50,000 in funds could be received in current year for costs incurred in developing, and what does it say? Student performance measures. Well, what did we do here, number 9? We spent $37,000 of research to develop student performance measures. So now we're saying, okay, federal government, thank you for the $50,000 grant. By the way, I just spent $37,000 on this exact purpose that you wanted us to. So at this moment in time, we can see, where's the $30,000? Here it is. We can debit the grant receivable and credit revenue. We're saying, okay, this is the time that we can record the $37,000. All right, number 10, accrued liabilities as of the end of the prior year were paid. And if I look, it says accrued liabilities were $40,000, so they were paid. The journal entry, debit accrued liabilities, credit cash. And lastly, number 11, these are the year-end adjusting entries, and we have a whole bunch of them. We'll take them one by one. So number 1, depreciation on the fixed assets were $90,000, so we will debit depreciation expense, credit accumulated depreciation. Next, what else is happening? It says the allowance for doubtful accounts was adjusted to $17,000. It didn't say anything about adjusting for $17,000. It's adjusted to $17,000. So we have to see what it was at the beginning of the year. Well, I see it right here. Accounts receivable net of allowance for doubtful accounts of $15,000. So it was $15,000. We're adjusting it upward to $17,000. There is a $2,000 increase. That $2,000 increase, we will debit provision for bad debts. Now, this is a contra revenue account. Got to be very careful. A normal a normal private nonprofit uses a bad debt expense account. A private nonprofit college uses a direct debit to the revenue account. A public nonprofit university uses a contra revenue account, which is this. So the accounting is different across the board. All right, what else is going on here? Accrued interest on investments, $1,250. All right, so journal entry, debit interest receivable, credit interest revenue. And last but not least, the fair value of investments at year end was $262,000. Well, what was my investment at the beginning of the year? Let me highlight it. Investments, $250. And at the end of the year, they've increased to $262. That's an increase of $12,000. So the journal entry would be to, here it is, debit investments and credit our revenue for the fair value change of $12,000. So those are all the various journal entries here, okay? And it also tells us of the income earned on the investments, all right, $5,260 was restricted. There's no journal entry per se at this moment in time, but I need you to keep that in mind when we go through our closing entries, and that's the last step here. So the closing entries, what we're going to do is we're going to close out all of our revenues with debits. We will close out our expenses and our contra revenues with credits. The difference, whatever is needed, debit or credit, is all going to get closed out to unrestricted. And hopefully you remember this from the proprietary fund chapter. We close out everything first to unrestricted net position. And after we close out everything to unrestricted net position, then what we do is we update our restricted and our net investment in capital assets. Okay, so first, the net investment in capital assets. What happened here? Well, there were two things that I recall. Net investment in capital assets increased by 525. You remember way back up here in number 5? I bought capital assets of 525. Now, in addition, I also depreciated those assets. Down here, 11B, 90,000. So it went up 525, it went down 90. So your net investment in capital assets went up a net amount of 435. Debit unrestricted and credit your net investment in capital assets to increase it, 435. And last but not least, your restricted net position, that's going to go up by $205,000. And let me just highlight them for you. If you remember back up in number 6, of the amount contributed, $200,000 was set aside specifically for construction of a new library. And in number 11, we just went through that. Out of the income earned on our investment portfolio, $5,230 was restricted. If you add up those two numbers, you get $205,230. And so that is going to be the increase in your restricted net position. And the opposite side of the journal entry will always go to unrestricted. All right, after all of those journal entries, here is your balance sheet. I don't know why we don't have an operating statement, but here is the balance sheet. And I want to point out the net position, the 3 categories, and you can see they have been increased or decreased based on those last 3 journal entries. You take the beginning balances, plus or minus all the activity and the closing entries, and you've got yourself your 3 categories of net position. All right, so now that we saw an example of a private nonprofit university and a public nonprofit university, now what we're going to do is I'm going to take you through 7 journal entries, and we're going to look at them side by side and record them as if we had a private nonprofit university and as if we had a public nonprofit university. So let's take them one by one. First, number 1, and you're going to see some of them are completely different. Some of them are very similar, but some of them are completely different. Number 1, in the current fiscal year, the university was notified by the federal government that next fiscal year it would receive a $500,000 grant for wetlands research. I need you to remember that, wetlands research. That's going to come in handy. Okay, so what we're going to see here, wetlands research, we got a notification from the federal government that we're going to receive it next year. Well, with a private institution, that is considered a contribution with a restriction. It's really a time restriction. There's also a use restriction on it. It has to be used for wetlands research, but it could be used it's going to be also received in the next year. So it's like a double restriction, right? Time as well as use. In any event, it's a contribution. It's unconditional. All right. We're going to receive it. All right, for the wetlands research. Okay, it's not like we need to do something first, right? We're definitely going to get it. All right, as long as we're going to do the research. That is a contribution with a donor restriction. Okay, and the reason why I say it's unconditional is because this is what we do. This is what a university does. They do teaching and research. There's nothing new. And then we didn't receive it yet, so we're going to debit the receivable. Now on the public university, just like we just saw, there's no journal entry required. We actually need to get there and actually do the research first before we record it as a revenue item. Okay, that was number 1. Now let's take a look at number 2. The university received a $500,000 endowment. Remember, endowment means it's basically a permanent contribution that can never be spent. So in a private nonprofit, debit cash, and we will credit contribution with donor restriction. And a public university, very similar, debit cash, but remember, there's we don't need to keep track of the different categories of revenue like a private university would have to. So we'll just simply credit revenues for the gift and grant. A little bit different, All right. Now, revenues and contributions are similar on the way they're handled on the operating statement, but there is some differences. Number 3, we can see this is pretty much the same thing. For the fiscal year, the university recorded $2.5 million in tuition and fees. Cash refunds of $325,000 were given. So on the private university, we're going to record the $2.5 million gross amount, debit receivable, credit tuition and fees without donor restrictions, and the refund given is going to be a direct debit to the tuition and fees account and credit cash. And you can see on the public university, it is pretty much exactly the same. Debit the receivable, credit revenue for the gross amount, and then direct debit to revenue and credit cash for the refund. So journal entry 3 is similar. Number 4, the university provided $12,600 in tuition waivers for students with outstanding academic performance. Basically, what has happened is the university basically waived and said, you don't owe us this money anymore. We're going to record that in a contra revenue account. You can see that first on the private university, debit tuition and fees discount, credit the tuition and fees receivable, and on the public university, it's accounted for in very similar fashion. We will debit the contra revenue, tuition and fees discount, and we will credit the account receivable. Okay, number 5. Number 5, there's a little slight difference. During the year, the university constructed a new street to allow for the expansion of its student housing efforts. The cost of the street was $1,980,000. So with a private university, which uses the FASB standards, we are going to see that the infrastructure is part of the property, plant, and equipment category. We'll call it land improvements, credit cash. However, the public university, we're going to have a whole separate category called infrastructure, and we will credit cash. That's reported separately on the financial statements. Number 6, the biology department spent $25,000 on, there it is again, wetlands research. Do you remember up in number 1 that the government was going to give us a grant if we did wetlands research? So number 6, we finally spent money on wetlands research. So remember, with the private university, we already recorded the $500,000 as a receivable, all right, and a contribution with a restriction. So what we have here is we're going to debit the research expense, credit cash, and now that we've spent the money on its rightful purpose, we can release those expenses or release the restriction out of donor restrictions into without donor restrictions. Debit net assets released dash donor restrictions. That reduces that column. And we will credit net assets released dash without donor restrictions. That credit will increase that column. Now, with a public university, remember, we originally never recorded the revenue or a receivable for the grant. But now that we're starting to spend the money on its rightful purpose, debit research expense, credit cash, and there should be a journal entry 6B here. At this point, we can bill the government. We can actually say debit grants receivable and credit revenue for the $25,000. And last but not least, number 7. At year end, $1,670 of estimated uncollectible tuition and fees was recorded. The private university is going to directly debit the revenue account, tuition and fees, and credit your allowance for doubtful accounts. However, the public university is going to use a contra receivable called provision for bad debts and credit your allowance for doubtful accounts. All right, so a lot of differences, and this is a great homework problem because it shows you side by side the differences between a private nonprofit university and a public nonprofit university.